Hello, here's Paula Sambo. I'm moderating the Muni panel for the Canadian Fixed Income Conference. And here with me, I have Christine Dacre, the CFO at Translink. I have Randy LeClair, the Director of Capital Markets from Toronto, and Ed Hankins, the Director from the York region. Welcome. I'd like to ask you, the three of you, to introduce yourselves and your municipal or transit authority. And while you are at it, if you could please explain the value proposition for investors. Why should they buy, Canadian municipal bonds or Canadian transit authority bonds instead of other government bonds or, corporates? Starting with you, Christine.
Okay, thanks. Hi, everyone, and thank you very much, Bloomberg, for hosting us for this event. It's a pleasure to be here. So as you know, I'm the Chief Financial Officer for Translink. So Translink was created through provincial legislation in 1999, and we're responsible for the planning, financing, and managing of public transit, in addition to roads and bridges. Our service area covers over 1,800 square kilometers, and we have about 2.5 million residents in Metro Vancouver. We consist of 21 municipalities, one electoral area, and a treaty First Nations. And our services are very wide. Bus service, we have a rapid transit, we have a commuter rail, we have on-demand transit service for people with disabilities, a passenger ferry, and operations and maintenance of the major road network. We own 4 bridges and 1 bike and pedestrian bridge. And we also have a dedicated transit police service. We're the only Canadian issuing transportation authority, and we began borrowing direct in the market in 2010, and we've raised just over $2.8 billion since then. So value proposition. Translink Credit offers higher yields than government bonds, but with similar risk profile. As I mentioned, we're the transit organization has taxing authority, and we're a regular issuer. We provide liquidity and laddering for portfolios to buy or hold trade on secondary markets, and we also issue green bonds for investors with ESG mandates.
Randy?
Thanks, Paula, and thanks to Bloomberg for having us on. Again, my name is Randy LeClair. I'm the Director of Capital Markets at the City of Toronto. City of Toronto, as you may know, it's an international city. It's the largest city in Canada with a population of 3 million people. It is the overall city is still growing. It's the 4th largest city in North America, and we have quite an ambitious schedule in front of us with an annual budget of about $14 billion and a 10-year capital plan of about $44 billion. The city's won a number of awards, and we appear on a number of listings as, things like the most livable cities and that type of thing. One of the recent awards we recently won was from Environmental Finance for our social bond that we did last year, the very first social bond by a public sector entity in Canada. As far as value for investors, to copy what Christine was mentioning, I think investors get a yield pickup for a very good quality credit. In some cases, municipal credits in Canada are rated AAA, higher than the provinces. Example, my colleague Ed from York is rated AAA, or similar to the province with this yield pickup. So that's really great value. Comparing to corporates, a little more difficult because we have it's hard to beat that yield that you see in corporate land. But given the legislative safeguards we have for investors that are embedded in municipal legislation across Canada, it's very, very similar to a regulated utility in the U.S., if not better, because of certain things like the sinking fund that we have for debt retirement. So all in all, when you package it up, it does compare well, first of all, to governments, but on the corporate side, it would be on the safer end, very high quality regulated utilities. So that's where we see it fitting into investor portfolios.
And Ed, what about you?
Okay, thank you, Paula. Good morning, everyone. And also thank you, Bloomberg, for hosting it. My name is Ed Hankins. I'm the Director of the Treasury Office and Deputy Treasurer for the Regional Municipality of York. And just York is an upper tier municipality comprised of 9 local municipalities. And if you don't know what regions are, I was going to say, think of them as counties with additional powers and responsibility. We're located directly above and share a border with the City of Toronto, and with a population of about 1.2 million residents, York is actually the 6th largest municipality in Canada. York has been and continues to be a growth municipality. This year, York will spend about $3.3 billion to provide services such as public health, police, roads, wholesale water and wastewater, paramedic, planning, and housing. With respect to the value proposition, I think we've already heard my colleagues say these here. I'll just say the short answer is compared to provincial bonds, major government, major municipal or major municipalities, their bonds are more highly rated, have very good secondary market liquidity, and offer a spread over similar dated bonds from their home province. For example, as I said, York is a frequent issue, holds a AAA rating with both S&P and Moody's, offers a very good liquidity, and has about a 6 basis point spread over a comparable province of Ontario. And as I think as Randy mentioned here, corporates, most of them tend to be in the single A, double B range, and obviously the probability of default would be for muni bonds would be minimal based on some of the legislative safeguards imposed. So it's a much safer bond. And still offering very good value.
Thank you, Ed. And as you mentioned, and Randy did too, you're probably one of the few public sectors worldwide joining the AAA spectrum. So I wanted to hear from you, what has changed in terms of funding costs or your size of investor base, and, what changed for you?
So yeah, that was something we're very proud of. S&P did upgrade us from AA high with a positive outlook to AAA at a time when most other our major organizations were seeing downgrades or at least negative outlook. And that's been very, very helpful. I mean, first of all, let me just say that this is not an overnight process. We've had fiscal strategies in place in order to try and ensure that we have a very sustainable program over the next number of years. So how's that happened? It's obviously helped a little bit in terms of our spread, although I have to be honest, we were probably treated as a AAA before, but this has obviously cemented that issue, and it's obviously opened the doors to a few more investors. So it's been very positive. We've been getting very, very positive feedback from our investors over the last few months or last month or so that we've had this rating.
Thank you. And Randy, you just issued your second social bond. I wonder if you could give us a bit of color about the order book, the type of investors who you attracted, and also the green or the green premium that you received.
Sure. In our sustainable debt issuance, we do both green and social. And for us, it's a matter of, again, one of the safeguards for investors in municipalities is that we can only borrow for capital projects, and we can only do, and we have to list them up for investment for our council and fund them accordingly. So it was quite easy for us to make the transition to do a framework. The framework was, reviewed by Sustainalytics and given an opinion that it was within the social bond principles. And the projects that we funded, the whole idea of social is to really assist those people in the City of Toronto that are disadvantaged, whether it be physically, mentally, it might be other challenges that they have, new Canadians, and seniors in our population. And so a big part of this is for social housing. So both the first and second issue that we did focused on both the shelter system, emergency shelter system, as well as the affordable housing that we have our new George Street revitalization program. And then this year, we also added our Easier Access program for transit. In Ontario, province of Ontario, we have legislation called AODA, Access for Ontarians for Disability, those Ontarians with Disabilities Act. And so we have put in transit, more elevators and other items that help those with physical, disabilities. As far as the greenium goes, that premium, there are a lot of investors that are interested in this market. I think there's more demand than supply. The book was almost 2.5 times oversubscribed for this particular issue, and the premium we received, better than our conventional issue, was about 2.5 basis points. And so we were very pleased with this result. The makeup of those in the book, we had in this one about 30 investors, 29, I believe it was. There was international U.S. interest. Over half of it is from Canada, asset managers, those with those particular projects. As a lot of it was asset managers that have funds that are focused on ESG and social bonds in particular.
Got it. Christine, if I'm not mistaken, the last time you issued green bonds was back in 2019. I'm wondering about your plans to use that program to issue more debt in the coming weeks or months.
Yeah, that was actually our inaugural green bond was in 2018, and then that was followed with one in 2019. And we've always said a lot of our capital program is green. So we did get a lot of questions early on, why aren't you issuing a green bond? And we always wanted to make sure that we did it right. We had the proper framework and whatnot. So my comment answer is when we can do green, we will do green. And a lot of our portfolio, as I mentioned, is naturally green. We do have other roads and bridges, other capital spend that we need to also apply, which obviously doesn't qualify as a green bond. But we are assessing. It's really based on our capital program and those projects that make it up. I will say one thing, though, with the green bond, making sure that it's dedicated, so we can't use those funds on anything but the projects with which we are borrowing the capital for. So I'm very happy that there is a bit of a look back. Otherwise, we'd be carrying a lot of capital as those projects unfold. So we really match our capital, our cash flow, our capital spend projections, and then determine whether or not we can bundle a green bond. So we will be, whenever we can, that's our first priority. As far as our next issuance, we're probably not going to issue until the first part of 2022. Normally we come in the fall time, but just with various capital spend changes in that, it'll probably be the first part of 2022, and we're hoping that it will be green. As I say, we're looking at that data now.
And over the medium term, Christine, how do you imagine your green portfolio being compared to the entire portfolio? I mean, do you have any projections of how much ESG bonds you could issue as a share of total bonds?
I haven't done that. It's probably a good thing to do. We're actually just redoing our next 10-year investment plan. So per our legislation, we have to get a fully funded 10-year investment plan approved by our Mayor's Council and our board. And our last one is expiring. So we're just doing that now, as well as with adjusting for, implications from COVID, of where our revenue forecasts are. We're looking for additional revenue to kind of replace some of the revenue that we've lost. So part of that investment plan will have some other projects. We know that government it has lots of different funding programs, and a big part of our capital program is funded through senior government funding, both the federal government and the provincial government, and then we make up the difference. Some of the major projects is about 40-40 feds provincial, and then 20% is the region. So we're really looking at what that next investment plan looks like, and then we'll be able to have a better assessment as to what fits into the green bond or not. But most of our projects that we do, expansion, transit expansion, we have a low carbon fleet strategy, so we're replacing all of our diesel and hybrid buses with battery electric buses, and that obviously qualifies for the green.
For sure. And Ed, not to brag, but Canadian municipalities, by and large, have better credit ratings than many states. Why do you think that is?
Yeah, thanks, Paula. I mean, there are a few key differences between Canadian municipalities. A lot of it comes around things like unfunded pension liabilities, unlike some U.S. municipalities that do have that. That's obviously something we don't have that as much. We have, like in Ontario, we have OMERS, which is a separate organization that funds those liabilities. They're expected to be fully funded over a period of time by legislation. Our liability is really just to make the annual contributions. We don't have things like sales tax revenue, which can fluctuate wildly from time. So I think we rely on the old-fashioned way. We just have property taxes and other very limited resources, which tend to be very stable. Other things like there's no equivalent, I'll say, of Chapter 9 bankruptcy in Canada. So unlike what happened in Detroit, this is something that is not even permitted in Canada. So we've never had a Canadian municipality ever go bankrupt here, and it's just not permitted. They do have, I think under legislation, there would be some type of workout strategy that would be done. I think I also heard Randy talk about sinking funds. All of our term debt has to be supported through the use of sinking funds that will be available at the time when that debt matures. The other things, there's a lot of legislative safeguards that have been built in. The fact that we cannot borrow, unlike senior levels of government that can borrow for operating costs, we can only borrow for things for capital. So there are a number of things that we were talking about. I know Randy mentioned a few others. I'm not going to repeat them, but that tends to be, I think there was one other thing is that a lot of Canadian municipalities, unlike other jurisdictions, not just in the US, but around the world, tend to have more reserves in there. That's just something that seems to be something that we've focused in on in the last 10 to 20 years here. Matter of fact, when we're talking about asset management reserves, it's actually a provincial mandate that municipalities have a plan for that.
Understood. And Randy, could you describe a bit your funding program and how that impacts your decisions on which currencies you're focusing on, your maturity profile, and which kind of instruments you're focusing on?
Sure. For the City of Toronto, our annual borrowing authority is $1 billion per year. So that's $1 billion in new debt. Our current portfolio is about $8.5 billion. And net of sinking funds, we've got about $2.3 billion in the sinking fund to be used only for debt repayment. It can't be repurposed. So it's a manageable for us. We also have internal policies on the debt service ratio set by our city council, which is at 15% of our operating budget can be up to 15% can be used for interest, and also sinking fund contributions are combined. So these are the kind of some of the things that limit us as far as borrowing. Looking forward, the program is it should continue on at around $1 billion per year. We are bumping up against that 15% debt service ratio. However, we're going to come out with a couple of other things. There's some new levies that the City of Toronto has, some other powers that other municipalities don't use. But so you're probably going to see an increase. As far as currencies go, we find that even with $1 billion, we're quite able to get done in the domestic market. Canadian dollar. One thing I get asked by a lot of international and U.S. investors that come to conferences is, do you do USD or any other currencies? And while the legislation does allow it, it is very difficult for the city, any municipality, to, we have to hedge it back. There's a lot of work that you have to do if you're going to issue. And so it's really, for us, we confine it to doing Canadian dollar debt. And we hope to continue in our conventional program, as well as the sustainable I mentioned. Sustainable runs about 1/4 of our new debt issuance roughly per year. About 250 million of that 1 billion will be in sustainable, either green or social. We'd love to get that increased, but similar to what Christine was saying, is that it does get limited by the amount of information you can gather as far as the metrics that investors want. I think that's probably one of the biggest things that hold us back from doing more ESG type products. So, but that's in a nutshell how we're looking forward at the City of Toronto and our debt program.
Thank you. And I'd like to hear from all of you, how has COVID impacted your municipality or transit authority, and how have you been handling it? And has it impacted your capital plan? If you'd like to start, Christine.
Sure. Yes, it has impacted us. The biggest area is in ridership. So our ridership actually got to the lowest in April 2020 at about 17% of the pre-COVID levels. It has steadily been rising since. The last month we were about 51%. I will say that since universities and schools have been back to in class, it's jumped up even more. So, it looks good that it's starting to increase. Also impacted was our fuel tax revenue. Obviously, people are working from home and traveling less, and as well as our parking tax revenue. So those are the three biggest areas where we were hit. We've been doing lots of modeling on what we predict our ridership will come back as. We're constantly updating that as new information comes as far as opening up again, different waves, looking at, talking to employers in the region about, what their plans are for return to work or what future work looks like. So we've got lots of modeling scenarios that we're doing and coming up with our, low, medium, high scenarios and trying to predict what that looks like as we go into our next investment plan and looking at what revenue do we need to sustain our operations. So all of that's, being done in lockstep. We are an essential service for the region. The province has seen that. We did get emergency relief funding from both the federal and provincial government. So we got $644 million, and that was to cover our net losses for 2020 and 2022. So that really was necessary, and that's put us on good footing. Fortunately, we were very, very financially sound prior, so we did not and do not have a liquidity issue. So it's just, as I say, looking at what the ridership and revenue looks like and matching our service to that. Capital programs, very little. We kind of were slowed down a bit in 2020, which impacted our borrowing for this year. But most of our capital projects are big projects, or a lot of our capital is big, and it's also funded partially, as I mentioned earlier, by senior government. So that funding is not at risk. So most of our capital program is not in jeopardy, and it's more of an operating side that we just need to make sure that we get that additional revenue to replace what we've lost, and then look at reducing our expenditures, which we have done over the last 2 years to help accommodate.
Perfect. And Ed, I'd like to hear a bit from you too.
Yeah, thank you, Paula. York Region is responsible for public health, and obviously we're directly involved in it because of the vaccination rate, and which is well over 80%. I mean, while it took a toll on our residents, I think, and the economy, we've actually been able to. It's now under quite a bit of control. We're down to about 71 cases per day. But from a financial point of view, it's had a pretty big budget. Well, it did have a pretty big budgetary impact on the region. Last year, it was about 187 million, mainly for the public health. We also do transit, lower fare box revenue, other losses of revenue. And as Christine was mentioning, we did receive senior government funding of about 90 million that helped partially offset. And then our council was in there early with respect to mitigating those costs. So we were able to mitigate them at the end of the year. We ran a surplus. This year, we're expecting about 200 million, which could actually go a little bit higher depending upon the fourth wave. Again, we have sufficient senior government funding to cover that off, along with the mitigation measures that we've already put in place. And if there's not, we certainly have sufficient funding within a lot of our reserves to cover or bridge any gap. I do want to make sure that it is a bit of a myth that we could run we'd end up running deficits as a result of municipalities cannot run deficits. We have to fund these as we go to do it. So I do remember early on in the pandemic hearing about potentially municipalities running deficits, but that certainly did not occur.
We're running out of time, but I'd really like to hear a bit from you, Randy, if you'd like to add anything.
Sure, I'll keep it short and sweet. To ditto kind of what both Christine and Ed have said, our impact was really all on the operating side, not on capital, very minimal impact on capital. Our operating, given our budget size of about 14 billion. We had a budget gap to start with of about $1.6 billion. The city came up with savings of about 500 million. So we needed about 1.2 of assistance from the provincial federal governments. I think if there's a silver lining in all of this, the needs of municipalities for infrastructure was really stressed. We kind of did it was a kind of a 5-point strategy. I won't go into all the points, but one of the main ones was to really get the senior levels of government, the provinces and federal government understand how municipalities are funded. A big shortfall for us was on the transit side. So if you can picture, our transit authority is within the city of Toronto and we fund them. And that's where the biggest shortfall was for us, was on the revenues from transit, again, sort of echoing what Christine said. And so I think the one thing that happened in all of this is that there was a greater understanding by those senior levels of government that they have to support infrastructure, municipalities, and especially transit. That's been loud and clear. And as we've gone through 2021, it was really easy to shore up some of the shortfalls that we were seeing. And recently our CFO mentioned that if there is a shortfall in 2022, she has 100% confidence that the senior levels of government will be there to back us.